now you've gotten the cash out of the insurance policy. You're no longer paying the premium, and the cash is working for you as hard as it can based on your investment risk tolerance and what you've placed it in.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. Today we're going to talk about should you keep life insurance in retirement. As you're nearing retirement, or if you're in retirement, you might have an existing life insurance policy, and it's probably a good time to take a look at that and determine whether you should keep it. I'm a big proponent of reviewing your expenses before retirement and during retirement to see if there are things that you can eliminate from your budget, and this might be one of those. So a few questions we're going to go through that will help you figure out whether you need life insurance, and if you do, how should you go about that? And then if you have an existing policy and you determine you no longer need it, what you can do with that. So one of the first questions obviously is, do you need life insurance? And how do you determine that? Well, there's a few different ways you can do it. One, you can just ask yourself, are you someone who feels more comfortable keeping life insurance? Maybe you feel more comfortable having a policy in place, knowing that you'll leave a certain amount of money behind to your spouse, maybe to your children. Maybe there's a charity that you'd like to leave money to. This is a way that you could do that through life insurance. However, as you're approaching retirement, if you're in retirement, chances are that you've set things up and you've got a consistent income stream coming in. And if that's the case and your spouse would be okay if you passed away, if they'd still have income coming in, either from your investment portfolio, from a pension, from Social Security, then you probably don't need life insurance anymore. You probably have enough assets accumulated that your spouse would be okay. And if you're getting close to retiring and you haven't gone through and figured out whether you have enough income to retire, then you probably should listen to my previous podcast, A Retirement Income Planning Strategy That Works, so that you can go through that process and figure out if you have enough income coming in. So if you've determined that, then you probably don't need life insurance. The next type of person that might need life insurance is that if you're in your peak earnings years. If you're trying to max out your 401k, if you maybe got a late start saving for retirement, then you probably need life insurance. If you're 4 or 5 or 10 years away from retiring, and if you were to pass away, if you're the primary income earner in the relationship in your household, then you probably need some type of life insurance. And you could do different calculations with that. You could just figure out how many years you need to continue to work to reach your retirement goal, and you could get life insurance that would cover you for that time period. Let's say it's 5 years or 10 years. Make sure you have life insurance that covers you for that period. Or you could get more detailed and figure out exactly how much money would your spouse need if you were to pass away. Those are the different options. I use some planning software to get more detailed with those calculations, but you don't have to do that. You could just figure out how much you're earning per year, how much you're taking home, and how many years are left, and that's how much life insurance you need. Another situation would be that if you had children later in life, if you have minor children, if you were to pass away, what would happen to your minor children? Have you set aside enough money to help them pay for school, for any other costs that they might have? In addition to having a spouse remaining, you probably need some type of life insurance. Another situation is that if you have a business or if you have assets that are illiquid, meaning you own real estate, you own things that couldn't be easily sold, then you might need some life insurance to help pay any taxes or any costs that might be associated with maintaining those properties. Those are some of the situations where you might need life insurance. There's probably others that I haven't thought of, but those are some of the main ones. So if you've determined that you still need life insurance, what type of policy should you have? Well, you probably know this, but there's two main types of policies. There are term policies and there are permanent policies. A term policy covers you for a certain period of time, meaning if you bought a 10-year term policy and you pass away in those 10 years, then the policy pays your beneficiaries. If you live past 10 years, the policy doesn't pay them anything. And I'm a big advocate of term insurance. There is a philosophy out there that you may have heard of called buy term and invest the difference. What that means is that The alternative to term is whole life or permanent insurance. And let's just say to get a $500,000 whole life policy, it was going to cost you $3,000 a year, or you could buy a term policy that would cost you $1,000 a year. So buying term and invest the difference would mean that in that situation, you'd buy the term policy for $1,000 and you'd invest the $2,000. There's a lot of information that has shown that over time, that strategy is going to accumulate a lot more money for you than with a whole life or permanent insurance. So I'm a proponent of using term insurance. Now, if you do want to go for a permanent policy, then there's a few different policies that you could use, and there is a place for a permanent policy. Permanent policy really makes sense if you need to have life insurance for the rest of your life. If you have a certain amount of money that you want to leave behind to your beneficiaries, or maybe you have a child with special needs and you need to leave a certain amount of money behind to them, then a whole life policy, some type of permanent policy is going to make the most sense for you. A term policy is not going to work because with term policies, there reaches a certain point in time where it's too costly to maintain them. You'd be better off with a permanent policy. So the three types of permanent policies are: one is a whole life, which is the most conservative, the most guaranteed, because as long as you pay the premium, the policy is guaranteed to pay you a death benefit, and there are no surprises with that. But it's not very flexible. If you want to not pay your premium, or you want to reduce the death benefit or reduce the premium, there really isn't the flexibility to do that. So because of that, what policies were created, one is called a universal life insurance policy. And with that policy, there's more flexibility with paying the premium and changing the death benefit, but what's not guaranteed is the interest that you're receiving. So with that policy, the interest rate is adjustable based on where interest rates are at the current time when you own it. So because of that, there could be negative surprises where if interest rates are low for a period of time, like they are now, you might end up having to put more money into the policy and pay more down the road. Whereas you're probably not going to find that with a whole life policy. And the next type of permanent policy is called a variable universal life. That also gives you the flexibility to not pay the premium in certain periods of time or make changes to the death benefit. But the big difference with that is you have investment type accounts similar to mutual funds where you can invest the money. So you could invest the money in stock funds, let's say, and with that type of policy, you could have greater returns than you anticipated in the policy, and you might have more money at the end of the policy than you thought, or the returns could be lower, just like a traditional universal life policy. And in that case, you would end up having to put more money into the policy. So if you're looking for permanent insurance, you'd probably want to look at one of those three, depending on your risk level. If you're really conservative, probably whole life. If you're willing to take some more risk, at this present time, probably the variable universal life would be better because it gives you more upside than the universal life. So if you are one of the people that's decided that you no longer need life insurance, if you've got enough assets saved up, your family would be okay financially if you passed away, and what do you do with one of these policies that you might have? Well, if it's a term policy, then you'd simply just stop paying the premium. And it's unfortunate that you've paid into it for a long time and you didn't get anything out of it, but it's also fortunate that you paid into it for a long time and you didn't get anything out of it. That means that you're still alive. If it is one of these other type policies that you have, either whole life, universal life, or variable universal life, there's a few options that you have. One is that you could just simply keep paying the premium. Or it's possible that maybe there's enough money accumulated in the policy where you wouldn't need to make any further premium payments at all. And to find this out, you'd want to reach back out to the insurance company or your agent and request what's called an in-force illustration. And this would be an illustration, essentially a calculation the insurance company is doing to figure out, based on the current interest rates and what you have in the policy, how long would the policy last without, let's say, you making any further premium payments. And they could tell you that it would last maybe until you're 90 and 100, or maybe only last another few years. So you'd want to have that run to see if you could stop making any payments. If you found out you had to make further payments, or maybe you found out from doing this in-force illustration you had to make more payments, then maybe you decide to also cancel this policy. And there's a few things that could happen. If there's no cash value in the policy, then it's relatively easy. You'd simply walk away from the policy and you don't get anything that comes with you. But if there is cash value in the policy, you have a few choices with that. With the cash value in a life insurance policy, it could be taxable to you. The way that you would determine that is by first determining the premiums that you've paid into it over the lifetime that you've owned the policy. So let's just say that number is $20,000 that you've paid into the policy, and your cash value is worth $40,000. That means you've made more on the policy than you've paid into it. You have a gain on the policy. But let's just say the premiums you paid into it were $40,000, but the policy is only worth $20,000, then you wouldn't have a gain on it. So if you don't have a gain on the policy, you simply can take the cash and there's no taxes that would be due. But if you do have a gain on the policy, you would have to pay taxes if you took all the money out of the policy, and that's taxed as ordinary income to you. Now, maybe you're in a situation where you don't really want to pay taxes on the money right now, but you would like to take the cash with you. Well, you could take advantage of something the IRS allows, which is called a 1035 exchange. And that is a tax-free transfer from life insurance either to another life insurance policy or to an annuity. And this could be any type of annuity. It would really depend on your situation, your risk tolerance, which annuity would be appropriate to you. There's three main types of annuities. There are what's called a fixed annuity, which is similar to a CD account. There's a variable annuity, which is where you can invest the money in different investment accounts similar to mutual funds. It has more upside but more downside. And then there's also one called an indexed annuity, which is a combination of fixed annuity and a variable annuity. But the benefit of doing that is now you've gotten the cash out of the insurance policy, you're no longer paying the premium, and the cash is working for you as hard as it can based on your investment risk tolerance and what you've placed it in. Because if you look at your life insurance statement each year that you receive, you'll see when you're paying your premium that the cost of life insurance is being deducted out of your cash value each year. That's the way that permanent insurance works. You pay into it, the cash value starts to build up, and then the cost of insurance is taken out each year. Each year, the older you get, the cost of the insurance goes higher. So by taking the cash out before you retire or when you retire, you're helping to preserve that cash longer than if you just kept the policy going. And with the money that's in the annuity, now you have the choice as far as when you want to pay the tax on the money. You could take a little bit of the annuity out each year and pay the tax as the money comes out, or you could actually leave the money in the annuity your entire lifetime, and then if you have a spouse and they then took over the annuity, they could also leave it in there during their whole lifetime. And then it's only once both you and your spouse have passed away that your beneficiaries would have to take the money out of the annuity and pay tax on it. Another option available to you also is you could annuitize the money that you have in the annuity and essentially create another pension for yourself. Based on your age, you could take out an annuity from the insurance company and annuitize it, and they would agree to pay you a certain amount of money per month or per year, however you set it up based on your age and based on the amount of money that's in the annuity when you decide to do this. So I think the key takeaways from this are that, one, ask yourself, do you want life insurance or do you need life insurance? And if your answer to both of those are no, and you have an existing life insurance policy, then you should pull it out, especially if it's a whole life, variable life, universal life, some type of permanent policy. You should figure out whether or not you have a gain on the policy. And if you have a gain, then think about maybe utilizing a 1035 exchange. Or if you don't have a gain, then you can simply just take the money out and cancel the policy. And you can also use this to partially subsidize your retirement income. If you do want to keep life insurance, then I also suggest you review your policy if it's a permanent policy. And if it's a policy that was bought in the 70s or 80s and it's a universal life or variable universal life, it's really important to get an in-force illustration and make sure that the policy is going to last as long as you need it to last. If you find by doing this in-force illustration that the policy will only last until you're 75 or 80, but you really want it to last and you pass away presumably beyond that, then you can look at either finding out how much you need to pay additional into the policy to keep it going, or you can maybe get a new policy that has more of a guarantee, either a whole life policy or a guaranteed universal life policy. Or maybe term insurance is another option for you as well. And with term insurance, if you're trying to keep term insurance until your 60s or maybe early 70s, and your policy only has another few years left on it, then you should definitely apply for a new term policy to make sure that the policy lasts as long as you need it to. So I hope this helps give you some more information on life insurance and what to do with it as you're approaching retirement and getting into retirement. If you haven't subscribed to this podcast, please do so on your Apple device through the Apple Podcast app or through Spotify or Pandora if you have a non-Apple device. And if you could give us any feedback on the podcast or rating, that would also really be appreciated. And please keep an eye out for our next podcast. If you haven't figured it out, these podcasts are coming out on Wednesday, and we hope that you tune in next time. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.